All right, good evening, everyone. Welcome to the trade findings and adjustments, as I just tried to get it up and going, for the 22nd, which would be what, Tuesday, the 22nd of September. Basically, what we're going to go over is a little bit on what real results are, and more importantly, a little bit of what we're doing in our portfolios. Now, I did not take Apple off yet. So let's go over some positions first. Long put protection. No, I'm going to start with this. In all honesty, the stock sell-off accelerates and expected to get worse before it gets better. I have an article here that has no less than 5 or 6 market experts, and I know that's debatable, right? But individuals within the stock market that give me enough reasons to believe we're probably going down before we go up. When we break the 50-day, we're then looking at the 200. It's just that time of year. It doesn't go straight down. It doesn't go straight up. But Stam Sobel, Chief Market Strategist at CFRA, which I have no clue who that really is, goes through the new coronaviruses that's really increasing over in Europe. For the state of Utah, we're getting some higher numbers, nothing like a California, a Texas, a New York, a Florida, nothing close to that, but our all-time high was 1,180-ish or something like that. Before, we were kind of freaking out if it got over 500. So you want to hear something pretty interesting? We have, green, red, orange. What is it? It's green, yellow, orange, red. Green means we're okay. Yellow, a little bit of caution. Orange, it could get serious. And red, it's very serious. We've been in orange as high as 550, 600. We go 961, 1180. We're staying in yellow right now, which just goes to tell me that this color thing and how bad it gets again is one more government piece of crap that doesn't work, is useless, and they can't follow their own guidelines. But we have Justice Court Ruth Bader Ginsburg, who has gone and passed. Lord bless her soul. Republicans will probably pick, in my opinion, a better individual if she gets elected, but we're going to hold off on that. Pass below the 50-day, which means the 200-day is where you're looking at. There's some technical analysis gurus out here. They're going to talk about that. Plain and simple, everything I went over yesterday is written in here. So, with that said, personally, and for clientele, I am more interested in keeping protection on verse on, I shouldn't say verse, instead of letting things go unprotected. So with that said, on Thursday, we're going to go over why sometimes the option prices are so screwed up. Why at times you don't make the money you expect to on the way down. I'm going to go over what constitutes or creates the option pricing. How it kind of sucks that 60% of options are theoretical data. I'm just going to work on helping you understand the pricing mechanisms that involve options and why to a certain degree, if you're looking for it to do what it does the moment you put your option on, you're going to find out that that's the only time that information even mattered. Anything before or after that really kind of has no bearing on how you originally saw your options. With that said, today I want to go over real returns, looking at a simple simple chart and information I brought up a while ago. Number one, the biggest way to help you understand, if you in any way, shape, or form have any advisor, a financial analyst, financial planner, and they're talking about you on average returns, they are going over and talking about this this red line are average returns. So, plain and simple, the moment you hear a financial guru talk about average returns, I'm going to ask you, what's the first thing that should go through your head? And Bill, I'm really counting on you to say something. Jeff Schaffner, I'm counting on you to say something. And William, I know what you told me last night. I want you to say it one more time. And I'm waiting for you to type it in before I repeat it, so I don't put words in your mouth. But I really want to hear, what's the first thing that goes through your head when you hear a financial guru talk about average returns? Abraham, you can answer too if you want to. But I know these three have told me something that I'm looking for in the past. So here we go. William, thank you very much. When I hear him talk about an average return, I'm listening to a jackass lie to me to my face. And yes, you did send me an email on that. No, I have not looked at that one. But yes, William, that's what I was looking for you to say. I'm hearing a jackass lie to my face, which is what you said yesterday or last night. Correct. Bill, type anything in that you want to. Jeff Schaffner, I know you've said something in the past, but yes, that red line is an average return, and under no uncertain terms has the market ever done that. In fact, the blue line is the percentage returns that you will see on our stock market. And then the gray line is the growth of $10,000. And you'll notice, plain and simply, that $10,000 18 years later is almost, if not on, 100% return. So it's taken more than 18 years to get that 100% return. Now, what I've done in this particular article is I went ahead and I graphed it out. And I think I did it with $1. So plain and simple, what you're going to do, if it is a negative return, 10.14% for a yearly return, what you do is you go to your calculator, and I've always taken 100, well, I've taken 1, and I've subtracted out of it the 0.1014, which equals 89.86. You multiply that by your, I think in this case we did the $100, and you find out that your $100 has turned out to be $89.86. In 2001, the yearly return on the S&P was negative 13.4. So you just repeat the process. You take your 1 and you subtract out of it the 0.1304, leaves you with 86.96. You multiply that by your previous year's starting amount, which was 89.86. 89.86. Boom, you're down to 78.14. As you go through each one and take out the minus, which it looks like I might have to do this a little bit differently. The short answer is you come out to a price of $188.52, 18 years after putting your initial $100 in. And actually, I'm seeing how I did this a little bit wrong. Now, if you have an up year, like up 26.38, you would just take your $78 and you multiply it by 1, which is your $78, plus the 26.38% return. And there you're coming up with a 26.38% return. It's interesting, and I'm probably going to have to redo this, but I'm going to redo this and put in 2019's, and I'm going to have it more accurate and updated, but you're going to find out that, and good question, someone just asked, I don't know who that was, but someone just asked me, where did I get this information? I went to, it looks like Macro 10's S&P 500 historical annual returns. And this is where I got the annual percent change, where I used all of these numbers to basically just create an Excel spreadsheet. I mean, that's all I did. Just create an Excel spreadsheet. And boy, that goes all the way back to 1928. Again, when I started in 2000. So that's the year that I mark as my point, and that's been the last 20 years. To a certain degree, I don't care before then because it wasn't my time. But very interesting is you take a look and you do those average returns, calculate it out. You calculate it out and you're going to find out that this historical average of a 7.75% return for 7.75 years doubles your portfolio. Just for the record, during my time that I've been in the stock market, I call bullshit. It hasn't happened that way. That is not accurate. It is not correct. On this, I gave roughly a 10% leeway or fudge factor if I had made a mistake, to show you that it was 18 years to double your portfolio. Yesterday, I talked about the lost decade. There it is right there. You can't afford to lose a decade. You've got to make something on these pullbacks down so you can make more as they come back up. And when you can do that twice over a decade, when you get to right here, you're at 100% return. When you get to up here, you're at like a 400% return. People ask me all the time, are you really doing what you say you can do? I've got 3 or 4 that are going to vouch for me. I guess I've got 5, my original 5, that'll tell you, you keep making money, the process works. The hard point is, what do you do during that process? I told you last Thursday, I believe, that it was time to take your profits on Under Armour. And we put protection on Under Armour. We kind of went a little bit out of the money, but here we have Under Armour bouncing off of the 50-day. If we see a little bit of follow through, we are going to take off our protection on Under Armour. If you came in on a protective put, you will not have enough to buy another 100 shares. You just won't. Even if you had 1,000 shares, you're only looking at about a 5% on the way down.
You want me to put
That is okay.
her seat in your
You're
car?
going to wait for the next cycle to make another 5% on the way down, which means you'll make 10% of your shares that you'll add your extra 100 shares to. Sometimes your protective puts are going to work in 2 or 3 cycles until you truly make enough money to add that other 100 shares. But what we're looking at is taking off with any follow through tomorrow with the 50-day. And we do know, hey, last time it really didn't bounce good. Hey, it kind of took a few days here. I get it. Took 3 weeks here. We get it. We're looking at taking off our protection on Under Armour and playing the bounce higher. That is what our plan is for Under Armour. So if you protected put it last let's see, someone's not muted. That is probably going to be Keeve. So Keeve needs to mute himself, but I will mute Keeve. There we go. Thank you. Keeve, glad for you to join us. All right, so really quickly, where did I lose you on that background noise? Yep, we got Keeve muted. He came in. Keeve has administrative privileges, so he comes in as an administrator, which means we can hear his mic unless he mutes himself on the program itself or I do it for him. But okay, let me go back then. My expectation last Thursday was you could buy a protective put, and I think we are closer to that $12 range. We're down at 10.98. Because volatility was high, you only made 5, 6, or 7% up on the way down. If we get a bounce tomorrow and Under Armour looks higher, we're going to take off our protective puts. We will not have enough money to pick up a full 100 shares. We did not make up the full 10% on the way down. That is okay. Sometimes it takes 2 or 3 cycles to make the full 10%. So you might need to do long puts one more time to be able to have enough profit to add another full 100 shares. But if you followed us, if we get a bounce higher tomorrow on Under Armour, take off your long puts. We're going to see if Under Armour can't run back up to that $12.50 range. $12.50 is where we would put our next set of puts going out to a November. If you added the leaps for 97 cents, now's a great time to add a couple more, maybe a third more to dollar cost average them. If you took off your leaps for 97 cents and booked like a 40% profit, 38 or 39% profit, now would be a good time to add those leaps back on. We're talking about the September 2022 leaps. So again, showing you this one more time in real life. What we just talked about, I believe, last Thursday. What you guys put on last Thursday or Friday was in that 97, 96 range. They're now worth only 61 cents. It's lost about a third of its value. So I would add a third more leap long call contracts into the position. For those that followed us on the covered call, you guys are doing better than we're doing. You got into a $12 covered call and you've made it somewhere between 61 to 74 cents. Tomorrow, if we have an up day on Under Armour, it's probably time to take those off and book that money. And let's see if Under Armour won't run back up to $12.50 range. So we have three different opportunities there, and this is the adjustment. The adjustment for the leap calls, add a third more shares into it. It's what I'm going to have to do to lower my cost basis. For those of you that took off your shares at 97 cents for the January 22s, you can go out to the September 22s, or you can do a January 22.50 as well. You can repeat this one, get back into it at 61 cents. In fact, I'm saying September, it's actually January 22, 22.50s. The September are a different leap position. So for those of you that added this position on, you can dollar cost average them. For those that got out, now's a good time to get back in, down at 61 cents again. And for those with protective puts, here's the time to see if we can get a run back on. I already know, Kevin, what happens if it falls? Well, you're going to book upwards to 74 cents to the mid 60s. Put them back on at 11. Put them back on at $11 and have your protective puts paid for. But again, if you're going to put them back on, I would suggest putting them back on from the Octobers, the 30th, going out to the monthlies. The reason why I go out to the monthlies is because that'll protect you through their earnings. And if you look at the options for Under Armour on the monthlies in November, going down to $11, they don't have it. That is a pisser. You got to go back to your October 30. Got to go back and you got to go to your October 30 at $11, which costs between 70 and 77 cents, which will basically be your profit on the 12s. Let's face it, your profit on your 12 is right in that range. I don't remember what I tell you, 64 to 71. It's going to be right in that range to pick these up. Those are the Octobers, though. I want the October 30th. Go to the October 30th, $11. There it is. It's also 72 cents. Last price to change is at 72. Even though the spread's 80 and $1.15. I wonder if the spread went up over the market close. Interesting. And here's those $12 are at 78 to 48. I'm pretty sure I saw it at 70. So it was 78 to 64, but most of them were closing at 72 cents. So plain and simple, little stuff to go over today. It's okay if you don't pick up your 100 shares if you can make up something on the way down. We're looking at taking off some of Apple as well. We've already taken off the covered call for a great return. We're looking at taking off some of the puts. Kevin, why would you do it for Apple and for Under Armour if you think our markets are going down? Well, these are the two that have been bucking the market trend. We now have Apple back above the 50-day. Again, if we see Apple moving up tomorrow, my expectation is I'm going to take off the protective puts. Kevin, what if you are wrong? You mean I'm not always perfect? Yep. If I'm wrong, I'm going to add them back on, probably at 110, and I'll pay specific attention when it gets down to 103. It's a process. You don't have to be right. You just have to make up some of the downward movement. And it's interesting, Apple and Under Armour have been the two that I've seen bucking the market trends. So with that said, one more time as a recap, if you want to add some leap long calls, now's the time to do it. January 22, 22.50, you can get into those right now for a whopping 61 cents, especially if you took them off. For myself, these are what's left over for me. So I would be adjusting these ones, plain and simple. I would be buying 10 more, and I'd be looking for a limit price of 61 cents. Maybe I'll give me 62. For those that have protective puts, you're down slightly. Cash in your 72 cents. See if you get a bounce from the $12 up, from the $11 point right now up to $12. You could close it at that $12, break even on your stock, have the 72 cents on the short call, or excuse me, use the long put, 72 cents divided by 12 bucks. It's a 6% return. You might get that 6% return in 3 weeks. You're not going to hear me annualize it and multiply that 6% return in, 2 weeks, divide it by, 25, and say you've got some 150% return annualized. Anytime you hear someone annualizing a return, you know that they're feeding you a crock of BS. But a quick 6% return in 2 to 3 weeks, not bad. Any questions? Any questions in general? And yes, I will redo this this worksheet. My goal is to redo this one, and I will do everything I can to if you're interested, I'll get this sent out to you guys. Or I'll probably, what I'll do is I'll post it on I'll post it on Facebook or something. All right, hey, I don't see any questions coming in. Guys, have a wonderful evening. I do hope this is helpful. I'm not trying to force any trades, so if I'm not able to get a trade for you, I'm going to try to teach you something. I'm going to try to mention something or teach you something that'll be of help to you. We do have one quick question that came in. The comment was, I've been observing that volumes in the options of S&P and QQ are getting closer. Is that a change in behavior? Not necessarily. What you're probably seeing when you see them getting closer are the standard movements in and out of funds, and you're not seeing retail, or because there's uncertainty, you're not seeing a bunch of new buying or selling one way or the other. So usually during those times of uncertainty, once you get that initial spike, you see the volumes kind of come together because no one's sure what to do. There's some that have to get cleared out. There's some that are moving on a constant basis due to the fund. But what you're really seeing is the uncertainty. So you're not seeing the spikes of buying or selling because no one knows where things are going to go. So that is most likely what those volumes that are getting closer or more like each other is the uncertainty that people don't know where to put their money. So they don't. Kind of what we're doing. Good question, Abraham. Any other questions? Let me go through to see if I missed any of them. Jeff and Bill, I'm surprised you didn't answer with my first question. All right. Good night, everyone. Appreciate your time. Have a great evening, and we'll see you Thursday morning. Good night.